Well, Vunani has narrowed its full-year headline loss per share to 11 cents. This while revenue from continuing operations ticked up 1% to 107 million rand. Butana Khoza, who's MD of Vunani, joins us now for more detail on the numbers released this morning. Butana, thanks so much for joining us in studio. So work in progress that we're looking at here. We're seeing a slow whittling away of the position you were in the prior year to where we're sitting today. Take us through the year that was.
Yeah, I think it was a watershed year in many ways. We made it clear at the beginning of the year that we wanted to actually deal with the legacy issues once and for all, and I think that we managed to accomplish that. We restructured our balance sheet, I think, effectively dealing with the last of the major problematic debt. It left the balance sheet a lot lighter, but also with debt levels at a very comfortable level.
What
for
are we
ourselves.
looking at right now?
Well, at year end it was 128 million, of which about half was current. The current portion was actually settled in February. So if you look at long-term debt, it's probably about 60 million, of which a large part of that is actually about half is really finance cost related, so provisions, guarantees and the likes, that don't have any debt service element to it. It's just so really IFRS related.
That part of the balance sheet that we're looking at, and we're looking at your strategy to de-gear coming into play here. Take us through some of the other strides you've made in turning this business around, and where you see return on investment coming through as you move forward.
Yeah, I think the platform is a lot stronger. I think we in our property division, we have our Manco. It's effectively a fund management business for all intents and purposes. We've got no gearing in that particular business. I think that the prospects for that property portfolio, Vunani Property Investment Fund, are pretty good going forward. I think in our fund management business, our retirement fund management business, we've had some significant wins over the last year, about 2.8 billion really growth in funds under management, which I think has stabilized that platform. I think going into this new year, still very encouraging results in terms of new business flows in that particular business, and I think it's going to be one of our winners going forward. I think we still have some throughput coming through on the on the property development side, some property developments coming to completion, which will make a contribution in the current financial year. I think our stockbroking business had a tough time last year, but I think they were not on their own. I think generally that industry struggled a bit, but I think notwithstanding that, we're able to come in pretty much have a decent performance. I don't think we lost money there. I think we were unlucky on the advisory side. We're heavily exposed to the public sector side, and government infrastructure spend didn't really come through strong enough.
Are you looking to see shifts, given past experience, moving forward, and a change in tack?
Well, I think that certainly we've right-sized our corporate advisory business just to be a bit more prudent, because there has been disappointment in terms of the work coming through. Government seems to indicate that they still see or have strong intentions to actually spend on the infrastructure side. We're going to be a bit more cautious, and so our costs are a lot lower than they were probably a year ago. I think we're quite comfortable with the rest of the businesses. I think that we've got pretty decent businesses, a great platform, and the story is really about consolidating around our platform and starting to see some cash generation, and hopefully in the short to medium term some dividend payments.
In fact, when it came to your investment holding side of things, you devoted a lot of your time to restructuring the investment portfolio there. What kind of restructuring have you gone through?
Look, I think predominantly there it was an asset sale process in conjunction with our lenders, really disposals. And so from that particular point of view, really we don't have geared investments on our balance sheet. I think we had very heavy exposure to geared investments in the past. I think that investments on the balance sheet at the moment are completely unencumbered at the moment. So I think that is a positive. means that any cash flows that come from dividends from those investments really are our cash flows, and any cash flows that we generate from our businesses are also our cash flows, and hopefully we are moving into a season where we can accumulate cash and hopefully look at distributions. I think we're going to be a lot more cautious around acquisitions going forward, obviously using as much cash as we can, and obviously looking for opportunities that actually augment our balance sheet.